In 1971, something changed. Not loudly, not with a vote, but the relationship between what people earned and what things cost quietly separated. Wages stayed flat, prices kept rising, and the gap between them filled with something else, something invisible, something borrowed. For most of human history, debt was simple. You borrowed grain to plant. You repaid grain after harvest. If you couldn't repay, you lost land. Everyone understood the terms. By the mid-1900s, that changed. Debt stopped being about survival. It became the foundation of growth itself. Countries began borrowing to build highways. Corporations borrowed to expand faster than earnings allowed. Families borrowed to buy homes they couldn't yet afford. And the logic felt sound. If the future would be bigger, richer, more productive, then borrowing from it made sense. The system ran on one assumption: tomorrow would always be larger than today. Here's what actually happened. Debt doesn't just move money forward in time, it pulls demand forward too. When you borrow to buy a car today, you're spending money you don't have yet. That stimulates the economy now. But it also means you'll spend less later, because you're still paying it back. At the individual level, this feels manageable. At the system level, it creates a treadmill. To keep growth stable, the system needs more borrowing. Not just from you, from everyone, every year. And when borrowing slows, the economy contracts. Not because productivity fell, but because future demand was already spent. This is where most explanations stop. They tell you debt creates growth. They tell you it creates risk. They rarely tell you what happens in between. The space where the system depends on something it can't actually control. Human behavior, confidence, the willingness to keep borrowing even when it stops making sense. In 2008, the treadmill stopped. People stopped borrowing, not because they wanted to, because they couldn't. Debt had reached a threshold. Incomes couldn't support more. And when borrowing froze, the entire system seized. Not just banks, not just Wall Street, everything connected to credit froze. Car sales, home sales, business expansion, hiring, all of it stopped. Governments responded by lowering interest rates, making debt cheaper, encouraging more of it. It worked, for a while. But by 2020, interest rates had nowhere left to go. They were already near zero. And debt levels, personal, corporate, national, had never been higher. Then inflation returned, not from wages rising, from costs rising faster than incomes could keep up. And the gap between what people earned and what things cost widened again. Here's what this feels like on the ground. You work the same hours, you produce the same output, but rent costs more, groceries cost more, insurance costs more, and the gap gets filled the same way it always does, with a card, with a loan, with a payment plan. It doesn't feel like a trap at first, it feels like flexibility, like access. But over time, the math shifts. More of your income goes to servicing what you already bought. Less is left for what comes next. And the margin between comfortable and precarious shrinks. Not because you made a mistake, because the system requires it. There's a pattern here, one that shows up in every economy that runs on debt. At first, borrowing finances growth. Roads get built, factories expand, jobs multiply. The debt pays for itself because productivity rises faster than the cost of servicing it. But eventually, that ratio inverts. Borrowing stops funding new capacity. It starts funding the gap, the difference between what people earn and what they need to spend. And once that happens, debt stops being productive. It becomes structural. You can see this in the numbers. In the 1950s and 60s, most corporate debt went toward expansion. New plants, new equipment, new research, things that generated future revenue. By the 2000s, more debt was going towards stock buybacks, dividend payments, executive compensation, not building the future, extracting value from the present. The same shift happened in households. Debt used to finance a home, a car, maybe college. Now it finances groceries, utilities, medical bills, the basics. That's not a moral failure. It's a signal. It means incomes aren't keeping pace, and the gap is being managed with credit, which works until it doesn't. Debt isn't evil, it's a tool. But like any tool, it has physics. When you borrow, you're trading future flexibility for present access. That trade can make sense when the return is higher than the cost, when the timeline is clear, when the income is stable. But the system doesn't wait for those conditions. It encourages borrowing regardless, because growth depends on it. Jobs depend on it. Markets depend on it. And over time, the question stops being whether you should borrow. It becomes how much you can afford to service. That's the shift. The trap isn't the debt itself. It's the belief that access and ownership are the same thing. A financed car feels like your car. A mortgaged home feels like your home. But legally, structurally, they're not. Not until the last payment clears. And until then, you're renting your own life from the future. There's a line in the deeper episodes on Luxona Vault. It follows what happens when entire nations cross this threshold, when the debt becomes larger than the economy that supports it, when servicing it requires more borrowing. And the cycle tightens. That's not speculation. It's already happening, in more places than most people realize. Japan has been there for decades. Debt over 200% of GDP. Europe is approaching similar levels. The US crossed significant thresholds years ago. And the response has been the same everywhere. Lower rates, more borrowing, extend the timeline. It buys time, but it doesn't solve the underlying problem, which is that the system requires perpetual expansion, and expansion requires resources, money, energy, materials, labor, all finite in practice, even if not in theory. Here's what doesn't get said enough. The system isn't designed to trap you, but it is designed to grow. And growth requires participation. The more people borrow, the more the economy expands. The more it expands, the more borrowing feels normal, safe, expected. And the line between using debt and being used by it becomes harder to see until it's already behind you. There's a quiet group of people who noticed this early. They didn't opt out. They didn't panic. They just positioned differently. They held more cash than felt comfortable. They avoided leverage that required perfect conditions. They built margin into every decision, not because they feared the system, but because they understood it and they knew fragility compounds. That positioning doesn't make headlines. It doesn't feel exciting. But when the system tightens, and it always does eventually, it's the difference between adjustment and crisis. You can see this in how they move. Slowly, deliberately, never racing toward opportunity, never fleeing from risk, just consistently choosing the path with more room for error. more time to think, more options if conditions change. It's not about being right. It's about still being there when others aren't. In Luxona Vault, we follow that pattern further. What it looks like across decades, across market cycles, across generations. Because the timeline matters, and most content cuts too early. Back to the bigger picture. Debt built the modern world. It financed highways, factories, power grids, schools, hospitals. It allowed entire nations to accelerate past what savings alone could build. And for a long time, that worked. The returns justified the cost. But somewhere along the way, the ratio flipped. Debt stopped being used to build productive capacity and started being used to sustain consumption, to paper over the gap between earnings and expenses, to keep the system moving even when the fundamentals weakened. And once that shift happens, the math changes. Because consumption doesn't generate future income, it consumes it. And debt used to fund consumption doesn't build equity, it builds obligation with interest. You can see this in household balance sheets, in corporate buybacks funded by borrowed money, in national budgets where debt service becomes the fastest growing line item. It's not hidden, it's just not framed as a problem, because the system can't afford to frame it that way. Not yet, not while the treadmill is still moving. There's another layer here, one that doesn't show up in official statistics. The psychological cost of living on borrowed time. The constant low-level anxiety of knowing one missed payment could cascade. That your financial life operates with almost no buffer. That stress doesn't get measured, but it compounds. It affects decisions, health, relationships, the ability to think long-term. When you're managing payments instead of building wealth, your attention goes to survival, not strategy. And that's exactly where the system wants it. Because people focused on making payments don't ask bigger questions. They don't question why wages haven't kept pace with productivity. They don't question why housing costs have detached from income growth. They don't question why education requires decades of debt to access. They just keep paying, and the system keeps running. Here's the part that stays with you. This isn't about blame. It's not about greed or stupidity or moral failure. It's about incentives. And once you see the incentives clearly, everything else makes sense, not in a comforting way, but in a way that removes confusion. Banks profit from lending. Governments depend on growth. Corporations answer to quarterly earnings. Consumers want access now. Every part of the system is behaving exactly as designed. The trap isn't intentional, it's emergent. And emergence doesn't care about fairness. It just follows the path of least resistance. So what does that leave? Not panic, not paralysis, just a different kind of awareness. The kind that changes how you see every offer, every monthly payment, every 0% financing deal. You start asking a different question. Not, can I afford this? But what am I giving up by saying yes? And that shift, that reframe, is permanent. Once you see debt as a trade between future freedom and present access, you can't unsee it. Every choice carries weight. Not moral weight, structural weight, the kind that compounds silently over time. Some people never make that shift, and that's fine. The system works for them too, as long as conditions stay stable. But for those who do, who see the treadmill for what it is, the game changes. Not the rules, just how you play. You stop optimizing for access. You start optimizing for margin. You stop asking what you can afford. You start asking what you can control. And control, in a system built on debt, means owning your own time, not having it leased back to you one payment at a time. That's the insight, the one that doesn't fit in shorter frames. Debt didn't trap everyone because it's evil. It trapped everyone because it worked, until it required everyone to participate. And now, the exit is narrower than the entrance. Not impossible, just harder to see when you're moving at system speed. The Vault episodes slow down here. They follow what happens when nations can't exit, when the debt compounds faster than the ability to service it, when the only tool left is to make money worth less, to inflate the problem away, which works for those who see it coming, and compounds the trap for everyone else. Because inflation doesn't erase debt, it erodes savings. It punishes the people who played by the old rules, who saved instead of borrowed, who waited instead of leveraged. And it rewards the people who understood the new rules, who borrowed cheap and bought assets that inflate with the currency. That's not fair. But fairness isn't how systems operate. Systems follow incentives. And the incentive structure changed decades ago. Most people just haven't adjusted yet. There's a moment that happens when you realize this. It's not dramatic, it's quiet. You're scrolling through an offer, 0% for 12 months. And instead of feeling like opportunity, it just feels like noise. Because you've seen the pattern, you know where it leads. And once you know, you can't unknow. That's what Luxona does. It doesn't tell you what to do. It just shows you the shape of the system. And once you see the shape, the rest follows naturally. Welcome to Luxona, the Netflix of finance.